Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for the third quarter of 2015. My name is Nick Basso, and I am a portfolio administrator in Ironwood's Asset Management Division. Tonight, it is my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Steen Rogers. Steen is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has any questions for Steen during the webinar, please feel free to type them into the chat box on the GoToWebinar panel at the side of your screen. We will certainly do our best to address all questions at the end. And now, without further delay, please join me in welcoming Steen to lead this evening's presentation. Steen?
Thanks, Nick. Good evening, everybody. Thank you for joining us on another Market Insight call. Tonight, I want to go over three things. I want to spend most of our time going over three main topics. Those are, as you probably are aware, the Fed and the imminent rate hike that we all expect. Go into that in detail and give you what our opinions are and how that what the investment implications could be of an increasing interest rate environment. The other two topics we want to discuss are Greece and the agreement that they made with the ECB, and then finally we want to talk a little bit about China. We're going to spend most of the time talking about those three things, but I will also go over the normal data that we normally go through, the normal economic data, but I will be skipping some slides because we've got a lot to cover today with the extra focus on those three main topics. So without any further ado, I'll go ahead and get going. Here's our disclosures to make the attorneys happy. Okay, topics to cover. I already discussed that a little bit. Quarter two results. Large cap domestic equities actually underperformed developed international and emerging markets during the first half of 2015. This is something that we kind of were expecting because of the past performance in international and emerging markets and how they had lagged compared to domestic. So that wasn't a surprise for us, but that did happen in the first half. The 10-year Treasury rose 41 basis points from last quarter, also something that we were anticipating, and we believe that rates will continue to go up. That had an impact on the bond markets, and we'll discuss that a little later. ISM manufacturing improved from quarter one, but it still was a lot slower than 2014. ISM non-manufacturing slowed from Q1. However, just this morning, literally this morning, the highest number ever hit on that ISM index was hit, and that index goes it doesn't go back far, but it is an index that we do look at. It goes back to 2008, and it was the highest that's ever hit. And if we look at a very similar metric, it's another leading economic indicator. It was at 64, the POP numbers, and the POP numbers haven't been at 64 since 2004. So I say that the U.S. economy slowed, and then this morning we get a great number like that. The market didn't do anything. Well, we also got some revisions to GDP, which I'll go through about 7-8 days ago, which also show that we may not have been slowing as much as some of these indicators would have signified. The job market also continues to improve. Unemployment is at 5.3%. However, in the same breath, if you're going to talk 5.3% unemployment rate, you have to also caveat the fact that the participation rate is at 62.6, which is the lowest it's been in literally 3 decades. So those are the economic indicators that we're looking at. I'm going to breeze through the next couple of slides pretty fast. I know we do have some new folks on the call, but in order for us to get through this entire presentation, I'm going to skip around here. Equity markets still doing really well, 205% since the trough in 2009. These are domestic equities. International, not as good, up 100%. So maybe a little bit more room to run, maybe not. Just because the markets are up significantly from the financial crisis doesn't necessarily mean that it's the end of the run. As you can see here, there are long periods of time, 20-year periods of time, where the stock market continues to increase. Now, this is looking at the domestic stock market, but it's not out of the question that stocks can't continue to go up from these levels. So that's the only reason I added this slide in. This one right here I wanted to just spend a little bit of time on. Our current PE ratio of 16.4. We tried to show that we're, even though we're a little elevated in some of our valuation metrics, we're not way off. We're not extreme valuations. And you can see that by looking at the 25-year average and then the standard deviation from that average. So the latest metric, or the latest reading of PE, forward PE multiples, is 16.4. The 25-year average is 15.7. That's only 0.2 standard deviations above the average. So really not significantly out of range. And with all of these metrics, you can see that they're not significantly, with the exception of this last one, which I'll discuss here, but the first 5 here, PE, the Case-Shiller PE, dividend yield, price to book, price to cash flow, all of these are well within range of their 25-year average. Now, you could make the argument that they should be higher than the 25-year average because interest rates have been at 0 for, almost 9 years. So that's going to, you could definitely make the argument that valuations should be higher in an environment like that. The last valuation metric is what we call the earnings yield spread. The earnings yield spread is one standard deviation away in the negative side. So the 25-year average, I guess where I'll start here is, what is the earnings yield spread? The earnings yield is the PE multiple flipped upside down. So instead of 16.4, it's 1 divided by 16.4 minus the BAA yield. And so right now that gives you a 1.3% earnings yield, or earnings yield spread, I should say. That spread is normally negative 0.6. So we either need higher stock prices or higher bond yields to get to that 25-year average. So we'll discuss this a little bit more. Actually, we're going to discuss it a little bit more right here. This real earnings yield, why I think it's important, is it usually, when the real earnings yield gets to 2.5%, it usually signifies that there's still some left in the bull market. The only exceptions to that were the 87 bull market and the 2002 bull market, where we never got to 2.5% real earnings yield in 2002, and in 87 we got there, and then we only went up, the S&P only went up 4% additionally from that. From the 2009 recession, we're up 205%, but we haven't gotten to 2.5% real earnings yield yet. In these other recessions, you can see that as we got to 2.5% earnings yield, the market still had 15, 16, 30, 49, 83%, and 4% to go. So stocks are in recent years, you could say stocks are fairly valued, I would say. In a low rate environment, one could argue that they're still undervalued. And then if you look at past bull markets, you could make the argument easily that stocks still have room to run. Now, these are all showing 20%. These are all showing after bear market, which is 20% declines. So it's showing, you know, what this chart here is showing 20% downturns, and it's showing all of those, or a lot of the ones that were just in the previous slide. So although there are four main reasons here where the market has gone down 20% or more, and there's four reasons that this usually happens: a recession, or a combination of two or three of the four. So a recession, a commodity shock, Fed tightening, or extreme valuations. So the first thing I would say is we're definitely not seeing a commodity shock. If anything, we're seeing the reverse of a commodity shock. Oil prices are near $45 a barrel. In 2008, they hit $145 a barrel. So we're definitely not, we wouldn't consider this a commodity shock. Extreme valuations, well, we just showed that we don't really have extreme valuations. We have fairly valued valuations, and you could argue that they're undervalued if you look at where interest rates are. So not so worried about that. Recessions can happen. The Q1 GDP getting revised to a positive number versus a negative number was a good sign. You know, recession can happen because of anything. I think the big wild card here is Fed tightening, and does Fed tightening change folks' their psychological feeling for the market, for their financial position, and does it make them, does it have an impact on their daily decisions? And does it have a big enough impact on housing? And I mean, there's a lot that can go awry if the Fed tightens too fast. I think the Fed has a very difficult job ahead of them. So we'll you know, I still think the Fed, watching what the Fed's doing is a very important thing. Now, all four of these things I think are very low probabilities, very, very low probability, very, very low probability, and then there's a good chance we'll be tightening. But even if the Fed tightened 100 basis points and we're at just over 1% Fed funds rate, you would still not consider that tight policy. That would still be considered easy monetary policy. So I don't think there's a big probability of any one of these four causing a 20% market decline in the near future at these levels. I think it's a low probability. However, what I don't think is a low probability is maybe instead of a full-blown correction of 20%, a 10% pullback is something that I think is very feasible, especially since we haven't seen one in almost 3 full years. Just to give you an idea, 2% or a 2% decline in the S&P 500, it usually happens about 18 times a year. So on average, a 2% pullback happens 18 times. A 3% pullback happens once a month, or about 11 times a year. A 5% pullback on the S&P happens once per quarter, 4 times a year. a 10% drop in the S&P 500 occurs once every year. We haven't had one for 3 years. And even in that third year, we dropped exactly 10% on the S&P 500. So I will be going over year by year, showing you the intra-year drops. But I think we've been lulled into sleep with low volatility, and we're starting to see a little bit of the greed coming in, and folks wanting higher rates of return, and that can usually, not usually, but occasionally that could, you could foresee a market pullback in those types of conditions. What have we seen from asset? I'm going to skip this one. Basically, developed market equities and small cap have performed very well. Emerging markets, very well. Now, this data is through June 30th, so a lot's happened since June 30th. It's only been a month, but a lot of these numbers are actually different now. But you can see developed market equity has been the best performer, and reached the worst performer, commodities, and so on and so forth. Nick, I think you need to hit your mute button.
I was still muted.
Sorry about that, guys. U.S. economy slows. So here was the big revisions that I was talking about. You can see that every July, the government agency that does the GDP report revises back years. And you can see where the previous numbers were 2.3% versus 2.2 in 2012. So not a big revision. 2013, however, 2.2 versus 1.5. That's a pretty big revision. 2014 came right in line. But you can see revised is blue and gray is the previous. And so you can see that there were a couple of big revisions, Q3 of 2012. One that was in the positive direction was Q1 this year, and that's significant because we did have a negative 0.2% GDP reduction, which if you have 2 GDP reductions 2 quarters in a row with negative GDP, that's a recession. That's defined as a recession. So this one changing to positive was a good sign, and it's positive 0.6. So it was a 0.8% difference there. It's going to help 2015's numbers. Hold on, I'm gonna mute Nick on the other line because something's wrong with his phone. He keeps going unmuted. Hold on. Okay. Sorry about that. Q2 came out 2.3% GDP growth. So that's the most recent reading, and so far it looks like Q3 and Q4 could be strong like last year's Q3 and Q4 based on some of the earnings numbers and based on some of the things that we've seen so far, but we'll want to make sure that we keep an eye on those. Long-term drivers of economic growth. So the GDP speed limit is measured, and you can get a good idea of where the max speed limit is by looking at 2 things: productivity and then growth in workers, or how many workers, the growth rate of how many workers are in the system. So we've got growth in workers plus growth in real output. That's basically productivity. gives us growth in real GDP. So in 1985, we saw a huge decrease in the population growth, and ever since then, the speed limit of GDP has been around 2.5%. So the high, the threes and 3.5s, probably not going to see that as a long-term speed limit for the U.S. economy going forward. Probably going to be somewhere between 2 and 2.5% because of the population growth or the workforce growth, and then the productivity. So I just wanted to point out that the days of 3 to 4% GDP growth are probably behind us. We may get a couple of quarters that are 3 or 4, but a whole year or a whole decade is probably in the rearview mirror. Cyclical sectors, I'm going to go through this pretty quick. Nothing's really changed on any of these. Last time we talked about, last quarter we talked about the inventory. I just want to make another comment about the inventory. This is a quick increase here. We want to keep an eye on this. This increase in inventory represents, when it goes back down to its normal level, we're going to see a negative 2% GDP hit. Now, it's not going to all happen in one quarter or 1 year maybe, but it is going to reverse over time as we continue to grow and companies get a hold of their inventory. They're going to go back down to normal inventory levels, and that's going to be a drag on GDP by about 2%. So that's something we brought up last time, and it hasn't changed. Confidence is high, which is typically not a great thing. It's much better to be an investor when confidence is low, as you can see from these charts. When we have low confidence numbers, the next 12 months from the S&P are usually pretty good. When we have high confidence numbers relative to the recent trend, you don't have as good of S&P 500 growth. So just want to point out that they're elevated, and we want to make sure that we're not overly optimistic at these levels, even though a lot of people are feeling a lot better than they did back in the recession or even a couple of years after the recession. Employment levels. Employment levels have improved. The labor market has tightened. The wages still haven't come up. That's the next thing we're looking for. This unemployment report comes out on Friday, so we'll get another employment report. We expect the unemployment rate to drop to 5.2%, and we expect wages to increase a little bit. So as that tightens, that's going to put pressure on inflation and on employment going forward, and that's something that the Fed is looking at. We'll discuss that in another slide here coming up. Now, with talking about unemployment, you've got to talk about, one, we lost about 9 million jobs in the recession. We've gotten 13 million of those back. So we're a net positive, call it 5 or 4 million jobs. And the reason that the unemployment rate has come down even so fast, even though we've only increased the actual jobs by 4 million, is because we also have the participation rate has completely dropped, and that, there's several factors for it. The biggest is demographic. A lot of people are retiring, but there are a lot more people who are claiming disability right now than what we normally see. There are several different reasons for this. The main one being demographics. We just have more older folks who are leaving the workforce versus younger folks who are adding to it. Inflation was starting to tick up until recently. Headline CPI includes energy, includes food, whereas core CPI does not. Core is a more smooth indicator because it doesn't have energy and food, but we all know we eat and we drive our cars around and use fuel. So most likely what's going to happen is this core CPI is going to come down if the headline stays low like this, and that's a big part of that is oil. So the Fed's not going to be very concerned about inflation at these levels. Interest rates, the Fed, and monetary policy. Okay, here's where we're going to start to spend a little bit more time. This is a chart we always look at. This chart just shows that over the past 30 so years we've been in a interest decreasing environment. What has been added to this slide is, okay, how do bonds and how do stocks perform in a decreasing interest rate environment, and then in a rising rate environment, how do they perform? So you can see corporate bonds 1982 through 2014, during this falling rate environment, they earned 9.6%, during which annual inflation was 3%. So the annual real return was 6.6 from corporate bonds. The S&P 500 earned 11.7% over this period of time. Annual inflation was 3%. So the real return from stocks, or from domestic stocks, was 8.6. So these are very good returns over this period of time, real returns of somewhere between 6.5 and 8.5%. Those are strong real returns. In an increasing interest rate environment, you can see bonds actually from 50 to 81, almost 3%, even 5. So you were left losing purchasing power. Stocks were up 8.6 during this period. Annual inflation, once again, 5. Average annual real return, 3.5. So better, but a mixed portfolio is going to have a lot, it's going to be a lot more difficult to stay on top of inflation. Now, one thing that we can do with the portfolio is add things like commodities and real assets that do well when inflation is at 5% or higher. I'm not saying that inflation is going to 5%, but I do believe inflation is going to be higher than it has been. So we want to make sure that the portfolios are prepared for that as well. And then also just pointing out the average real yield. So real yield is just whatever the nominal yield is minus inflation. Our real yield right now is 0.63%, and the average real yield over the last, call it 70 years, is 2.48%. So we're almost 2% lower right now than we normally are. And once again, inflation is, roughly 2% lower than we normally are. So, yields need to be going up, or inflation needs to be going down, which I doubt, to get that real yield higher. So we expect that when the Fed starts hiking, to see rates increase. What does the Fed think? When are they going to raise? I'm sure you guys have all heard media outlets saying, is it going to be September? Is it going to be December? Is it going to be 2016? Well, what I can tell you is the folks making those decisions, the actual FOMC members, if you look at their year-end estimates as of this last meeting, you can see that they think that the Fed funds rate is going to be 0.63% by the end of 2015. That means that we have a quarter point in September and a quarter point in December. Now, that may not happen, but I would say that the Fed is trying to tell us by publishing these that most of the folks there think there's going to be at least one increase before 2016. The market, on the other hand, is pricing in, and this is the Fed funds futures, market expectations are for only one increase by the end of 2015. That's not such a big difference between now and the end of the year. I mean, it's 30 basis points, But really, what starts to intrigue us, or what we start to look at, is, okay, what about 2016 and what about 2017? So the Fed is saying that they believe the 2017 year-end Fed funds rate is going to be 2.88%. The market thinks it's going to be 1.76. So the market's priced in 1.76 into where it thinks bond rates will be at the end of 2017. So there's a disconnect there. Either the market's right and the Fed's not going to tighten as fast as they think, or the Fed is going to tighten as fast as they think they're going to tighten, and bond rates are going to have to significantly increase over probably, if the markets get a more clear picture on what the Fed's going to do and when they're going to do it and at what pace, which if we see a quarter point in September and a quarter point in December, we could see how that would spook a lot of investors in the fixed income markets. And we'll kind of get to that a little bit later on the ramifications of that. But here's what the Fed is telling us. These are the press release from July 29th, which was just a few days ago. And everything that has been changed in this statement from the last meeting is highlighted in yellow here. So in recent months, basically, we met in June, indicates that the economic activity has been expanding moderately in recent months. So they're saying they're discounting that first quarter slowdown. And in fact, since then is when the Q1 GDP was revised from -0.2 to 0.6. So GDP revised, let's say, let's check, add a tick mark to September, meaning we have a higher probability in September than December, if we're just looking at those two options. The housing, household spending and the housing have shown additional improvement. I'd probably take a check mark and check September again. This is the big one here. The labor market continued to improve with solid job gains and declining unemployment. That was a lot. They used the word solid there. So that's also a check mark on September. Now, in 2 days, we get another jobs report, which could help this further or could slow this down depending on how the jobs number comes out. We actually get 2 more jobs reports before the Fed has their next meeting in September. Underutilization of labor, so basically they're saying that the labor market is tightening up, which we showed in that previous slide. And then lastly, altogether, the FOMC has seen a lot of progress. They need to in order to adjust rates. They just need some more. So they added, instead of seeing further improvement, some further improvement. So they have seen some improvement. They want to see more improvement, is basically what that's saying. So we look at this press release and we look at what the Fed is saying themselves. We think September is looking probably a higher probability than December, and definitely than 2016. So that's what our thoughts are, and we've prepared for a rate hike for longer. A rate hike. When I say a rate hike, I mean the markets to anticipate a rate hike. Typically, markets will anticipate a rate hike, 6 months in advance of an actual rate hike, and we'll get into that. I'll show you that data here later in this presentation. Real estate, it's slowly improving, but banks still are not lending. I'm going to go through that one pretty quick. Here's where I want to spend a little bit of time too. So if what I said in this slide over here, if we have if for some reason, I don't think this is going to happen. I think the markets are going to react in a way where if the Fed does a quarter point in September, they probably won't do a quarter point in December. But if what they say the average, the average member here, if we take their year-end targets of 2 rate hikes between now and the end of the year, so September and December, if that happens, you're going to see rates go up. You're going to see folks getting out of bonds. And what concerns me a little bit is that we have dealer inventories, this left side here in the blue, and you can see that they were increasing until 2007. Dodd-Frank came out, which limited what bonds or what banks should be holding, and so that really drastically had an impact on dealer inventories. And so you can see ever since they've been declining. But look what's happening to the high yield debt outstanding. It's been increasing every single year with the exception of it dropped a little bit in 2008, but we've been increasing ever since. So we have low inventory, but a lot of bonds out there. So if we have a sell-off in fixed income, like the taper tantrum, it could get ugly in the fixed income market. And we've positioned the portfolio to be cognizant of that and to be a little more cautious, because if that does happen, it's going to create some buying opportunities for us in some of these bonds that we've really been avoiding because of the uncertainty of what the Fed would be doing. So this one we've had in previous slides. I'm going to go through it quick. Basically, shorter-term bonds have less interest rate risk than longer-term bonds. So an increase of 1% interest rate will have a lower impact on the price of your 2-year Treasury versus your 30-year Treasury. That's what we're trying to avoid, these longer-dated bonds and these more interest rate sensitive bonds, and we're trying to be more in the short term and less interest rate areas, so that if that does happen and we do have some opportunities to buy bonds at lower prices, we can do that. Okay, so that's fixed income. So what's going to happen with stocks with a rate increase? Well, if we have increased interest rates and they are orderly and we don't see a huge panic, it probably will be ultimately a good thing for stocks, because it means that the U.S. economy, the global economy, has picked up enough where the Fed thinks that, hey, the economy is on its 2 feet and things are good. And then we've got data here that shows when rates are low, meaning below 5%, and rates increase, there's a positive relationship between yield movements and stocks. So when yields go up, stocks go up. This is what this chart is showing you. As soon as we get to 5%, so if rates are at 5%, the 10-year Treasury is the rate we're talking about here. If the 10-year Treasury right now is at about 2.3%, just to give you an idea of where we're at right now. So we have 2.5%-ish to get to where the 10-year Treasury is now at 5%. Now, when the Treasury goes from 5 to 5.5 or 5 to 6, it has a negative relationship on stock returns. So as long as the rate movements are orderly and the 10-year Treasury doesn't go above 5%, it might be positive, or if we look at history, it would be a positive thing for stocks. And then if we look at the last 3 rate hike cycles, we can look and see, okay, well, what exactly happened? And so the first thing we want to do is take a look at, okay, what happened to equities? Equities are this top line. So this is the February 94 to 95. This is stocks up here, and this is bonds down here. So equities in the past start off with an adjustment. So as soon as the Fed announces, we see a little bit of an adjustment period. Stocks have to get used to what's going on, and then later on in the rate cycle, we see, okay, now we start going a lot better. This one, it was a little bit different, but early on we still came down. We just had a little bit of a pop and then came down, and then kind of an orderly upward trend in stocks. And then this one, very similar, down, and then an orderly upward movement in stocks. So, you know, those are the trends in the stocks. The rate hike, or the 10-year Treasury yields, you can see here that typically in 2 of the 3 here, we had a couple of months where the bond market took rates up before the Fed even raised rates. So before they even raised rates, the interest rate was going up. And it went up and up and up, and it went up and up and up, and it went up and up. Well, it went up a lot here. It went down and then up and up and up. And then at the end of the rate cycle, the rates start going down. So the market's been pretty good at predicting, being ahead of the Fed both on the upside and then on the downside as well. So this would tell me, if you look at these things, and they're not to perfection and there's no exact game plan, but it appears that if we look at recent history, the increase of a rate hike cycle would say that stocks may be bumpy and rates are going to go higher. And then ultimately, stocks are higher at the end of the rate cycle, and yields are much higher at the end of the rate cycle, but maybe starting to come down. So that's, I thought this slide was a real pertinent slide now that we're getting, we're a month or 2 or 3 months possibly from the Fed increasing rates. So I wanted to, put this one into the deck here. International. Okay, so that was the Fed. If you guys have any questions, like Nick said, make sure to write them in the question box on your GoToMeeting control panel. I'm gonna jump into international now, and international actually through the middle of this year was doing really well. Emerging markets were doing pretty well, both outperforming the domestic stock market. And then Greece reared its head up again and kind of took some of those developed market returns away, but not a lot of, not the whole thing. They're still outperforming the domestic stocks, but then China reared its head and completely wiped out all the emerging markets growth for the year. So July was a very turbulent month when it came to your international, especially your emerging market holdings and your commodity holdings. And we'll discuss those a little bit. But here I want to focus on Greece. So the Greece situation, there's a couple of things I want to say about this. One, seems to be under control for the moment. The deal that they did was really just kicking the can down the road for another 3 years, with Greece promising to cut spending, cut pensions, and raise taxes. So if you're living in Greece, you're probably not too happy about that. There's going to be a lot of change over there. We'll see if this deal, follows through, but they're working on it right now. The silver lining behind this is we were able to see what would happen because Alex Tsipras took Greece to the brink this time. The markets did not react, and you can clearly see that with this chart here. 2011, 2012, when we had the Greece issues, very similar issues, you had Greece yields skyrocket, and not only did they skyrocket, but they also took some of these peripheral countries' rates up as well. So Portugal, Italy, Spain, Ireland. This time around, you had Greece rates rising, and you actually, until the very end, you actually had rates of these other countries going down. And then not until the very end did you see the rates go up. But look, you're talking about all 5 of these countries, none of them having a rate over 3% when Greece was at 15. So what that told many people is that Greece is now not there's no risk of contagion, or a lot lower risk of contagion. And that basically took the last bargaining chip that Greece had with both the IMF and the ECB, took that bargaining chip right away from them, and that's why they had to come to the table and take these fierce austerity measures in order to get the funding that they needed so that they wouldn't default on their loans. Another piece that we can look at to show that contagion did not occur is the economic the leading economic indicators. You can see Greece completely fell off the cliff here, but it didn't have a lot of impact on these other countries, whereas when they were lower here, it brought some of these other countries down with it. So very positive sign being the fact that Greece is maybe not as much of a contagion risk as it once was. I want to make one comment about this slide, this graph over here at the top right, earnings revisions ratios. So this is basically, if it's over 1, you're getting upward revisions on earnings, and if it's below 1, you're getting downward revisions. And you can see for most of 2014, U.S. had a ratio above 1, whereas the Euro area had a much worse ratio here. And it completely flip-flopped at the beginning of 2015, where now you have the Euro area revising, companies revising upward, the U.S. Revising downward. Now it's improving, they're changing direction here. This has a lot to do with the U.S. dollar. Remember this slide because I'm going to bring it back up when we talk about the dollar and when we talk about some other things. China is the other one that happened in July, really at the beginning of July. You know, we had a couple days where the stock market was down huge. Net China is, and it's on the next slide, China is actually, after it all is said and done, as of July 31st, still up 2.5%. However, China was up 15% through the first half of the year. So in 1 month, they lost, you know, almost all of their gains for the whole year. That had a lot to do with some reports that came out that GDP growth was declining. They've actually, GDP came out just recently, so at 7%, which is slower than the 7.4, but it was actually a little bit better than the 6.8 that economists were expecting. 7% has been the last 2 quarters, so maybe we're seeing a little bit of stabilization. We did see some of the stock markets there, both the Shenzhen composite and the Shanghai composite, the forward PE multiples got pretty ridiculous, and I mean they're still pretty high here, but you know, earnings are also very low, so these prices came down a ton, and we don't have the updated data here, but there are some speculation going on, you know, now that in China there were some opportunities in real estate, but they kind of put the stop on that, People's Bank of China, and now some of those speculators have gone into the stock markets of some of these countries, and that's why you've seen that run up, and that's why the market was up 15% earlier in the year. People's Bank of China, they're trying to lower the reserve requirements, they're trying to lower the interest rates, they're trying to stimulate the economy. There's even talk of them buying stocks. Not a market that you want to play in without knowing what you're really doing. Very, very volatile. Don't want a lot of exposure to an area like this in the portfolio, but over a long period of time, if the country is emerging and they're growing at almost 7 to, you know, 7, we'll call it 7%, there could be some opportunity for long-term growth in those companies as well. So a small portion of the portfolio, but very volatile, as seen by the month of July. International markets have just been doing a lot better this year, and if it wasn't for the stronger dollar, they'd be even doing better. So you can see IFA here, which is just a big, broad-based, developed international stock index. It's up 13% in local currency. When you translate that to U.S. dollars, you lose 5% of the growth. You get 8.1, but that's still a lot higher than 3.4 from the S&P 500. Now, these numbers aren't matching up with the earlier numbers because these numbers are as July 31st, where the other numbers were through the first half of the year. So I just want to make that, I just want to point that out as well. Point out a couple of these other ones. France up 21.6 in local currency, up only 11 in, I mean only 11, but there's a big difference there, and it's completely, it's because the dollar has increased so much, and we're going to talk about that here in a little bit. Another thing that we want to point out here is correlations have come down since the financial crisis. That improves the reasoning, or it gives us more benefit to add these international stocks and emerging market stocks into a domestic portfolio that has domestic assets, because now you've got correlations that are a lot lower than they were, which adds to the diversification benefit. You want to find lowly correlated assets. The lower those correlations go, the better those assets are to add into a portfolio. Here's the dollar index. You know, same chart that we've seen for the last year now. The dollar really jumped last summer, and you know, it's gone up even since June, July. It's back up to above 90 now, and it's having an impact on domestic earnings. And you're starting to see trade deficit in the U.S., and you're starting to see trade surplus in Europe, Japan, and emerging markets. So what that tells us is that we think that at some point the dollar is going to decline. Currencies are very difficult to predict, and that's why we want to make sure we have a diversified basket of a lot of them, because at some point a majority of our clients, their biggest assets are denominated in U.S. dollars. So to diversify that out, we throw in some other hard currencies, gold, commodities, other things. Now, it just so happens that this is a period of time where the dollar has increased dramatically, and it hasn't had an impact on some of those other asset classes. But there'll be a time when it reverses to some extent, and some of those assets that have gotten hit hard recently will do better, and vice versa. And the big reason why is right here. The big reason why the dollar has increased so much is because we have divergent monetary policy. So we were just talking about the Fed and when they're going to start to increase interest rates. That is tight monetary policy. Well, tighter monetary policy. They still have a giant balance sheet, and we're still talking about, Fed funds at maybe 25 basis points. So we're not talking about a lot. But compared to Japan and compared to the ECB, it is tighter monetary policy. And so that's why you see, and that's why you've seen the U.S. dollar increase so much. It's because we've got easy monetary policy in some of these other countries, and the U.S. has been tightening or starting to go into that tightening cycle. Just want to point out some, these are the purchasing managers indexes. Just wanted to point out a couple. The Eurozone is the first one I wanted to point out, 52.5. You can see that's the highest it's been in a long time, and it's going in the right direction there. So the Eurozone is looking like it's gaining some momentum there. An area that does not look like it's gaining momentum is some of these emerging markets. They started doing a little bit better, and then we've seen a little bit of decline here. And then the U.S. It's not as great as it was in 2014, but it's not horrible either. We're still well above 50. 50 being, you're not growing and you're not declining, but anything above 50 and we're growing. So these numbers that are green are the good numbers. Yellow, we're kind of growing at a muted pace, and then red, we're not growing. We're actually shrinking. Valuations. Oh, valuations. Valuations are difficult right now because of the low interest rate environment. You can see the United States compared to history. If you look at the composite of these valuation metrics, you get a story that's telling you that it's one standard deviation away from the normal, the average valuation. But I don't think that really tells the whole story, because it doesn't tell the interest rate story. We've had low interest rates for a very, very long time, and you can argue that an elevated valuation is not inappropriate. And then you've got the international index, developed international index. It's closer to average. And so using the same premise of low interest rates, probably can make the argument that international stocks still have probably a little bit to run. And then you look at how U.S. stocks have compared to international stocks since the Great Recession. That first couple of slides where I showed U.S. stocks are up 200%, international stocks are up 100%. Makes sense that the international stocks are not as highly valued as United States, as domestic companies at this point. But for the most part, slightly overvalued. If you look at all of the developed markets, just slightly overvalued. If you're making that argument with interest rates, we could be, still attractive here. Emerging markets is a completely different story. Emerging markets have had horrible performance over the last 4 or so years, and they are actually under their valuation average with low interest rates. So this is an area that we are we believe there's a big opportunity there. You're going to have to deal with some volatility like we did in July, but we still think that some of these emerging markets are undervalued right now and discounted compared to where they should be. Earnings have been hit. You can see this right here, the last couple of quarters. The 2 big major reasons, we've already talked about the appreciation of the U.S. dollar, so that's going to hurt earnings. The second thing is all the energy companies are dealing with very bad earnings. The next slide, I'll go into that in more detail. But the things we have working for us are estimates going forward look very positive because of profit margins getting better, and leverage still is at very low levels. When companies start to feel comfortable, they're going to increase this leverage that they have, which is going to increase both top and bottom line numbers. And they can do it real easy. They just need to make sure they feel comfortable and it's the right time to do so. A lot of companies are still reeling from the Great Recession, playing it very safe. When I show another slide down the line here, not only is the leverage really low, but cash values are off the charts. And we'll get into that here in a couple of slides. But earnings have taken a hit, but their forward-looking estimates actually look like we could hit an all-time high in the next couple of quarters by the end of the year. Here's a slide that shows the Q1 2015 earnings per share growth year over year. So the S&P 500 lost 5.6% earnings, but if we took energy out, we would actually be growing at 8.5%. That's a solid number. You can see if we broke it out, 2014 Q1 earnings was $27 a share, and we can see the year end, or the 2015 Q1 is at $25.81, and then each of these areas added or subtracted. So financials added 75 cents. Energy, we lost 3.55 cents per share on the S&P because of energy companies. So energy and materials is where we saw a significant decline in earnings. If you take those out, you're looking at a completely different picture. So, and then once again, we've been dealing with this higher dollar as well. 17, almost 20% higher from Q2 of 2015. Yields around the world, you know, they're still, they still look positive. Equity yields, that is, and REIT yields, they still look pretty good when you get the capital appreciation of an equity and you get a dividend of, you know, in Australia, 4.8 versus their 10-year government bond, which is paying you 3, and you're not going to get a capital. You don't have the opportunity of the equity portion there. Even the U.S., you know, dividend yield of close to 2, and the 10-year Treasury at, you know, just over 2, doesn't look horrible there either. When you say, well, you know, in 10 years, if I invest in the S&P 500, I'm probably going to do a lot better than just the 2% you're going to get from a 10-year Treasury, 2.3% today. So equities still look pretty good when you take into account dividends. REITs still look pretty good when you take a look at their yields as well. What we need to make sure that we're careful of is that because we've been in this low rate environment for so long, there have been a ton of people who have reached for yield, and that is very dangerous because it means their portfolio is probably more aggressive than they want it to be. And if those asset classes start to get hit, you know, you could see people flooding those because they have the wrong time frame for that kind of asset. They're buying it because, you know, we haven't seen a lot of volatility in the last couple of years, and they're saying, well, if I can buy something and get 2% or 3% dividend yield, or a REIT at 4% in the U.S. Dividend yield, and the price has been going up at a steady clip, I'm getting the 4% plus price appreciation. This is great. But as soon as that price appreciation starts being price depreciation or a loss of money, and you see people exit those areas, because there's so many people that have reached for yield and maybe gone outside their comfort zone, you want to be careful in an environment like this. Here's what I was talking about, and in fact, it's even higher than that in Q2. It's at 66.8%. These are unprecedented levels. And not only do we have almost 67% money supply as a percentage of nominal GDP, but we also have an environment where CDs and interest rates are so low. You can buy a 6-month CD, 2 of them, $100,000, and for a year you're going to get $130 in return for your $100,000 in today's environment. So there's a lot of cash out there, and it's not paying a lot. That cash has got to go somewhere when investors start to realize that earning $130 on 100 grand is not going to cut it for retirement. And we're in a real difficult, you know, for our retiree clients who are on the call, it's a difficult market, because, you know, you've got a lot of more of your portfolio in safer income generating assets, and the Fed has really, quote unquote, taxed you with this low rate environment for the last few years. Granted, stocks have done well, so that portion of your portfolio has done well. But, you know, to build a safer portfolio, you need a lot of these safer investments that haven't really been paying us a lot of income, and it's, you know, starting to add up when you start to look at how long it's been where we've gotten anything from safer investments. So it'll be actually a nice change when the Fed does start to increase rates, and interest rates do go up. It'll give us a lot more opportunities in some of our income generating asset classes. I'm going to skip that one. Due to time constraints here, guys. I want to make sure we have some time for questions. These are ones that we always put in here. You know, you want to have the right time frame. You want to make sure that you're not in too aggressive a portfolio. You want to make sure you don't make emotional decisions. You guys get this. I want to spend a little bit of time here. So earlier I was stating that there's every year, on average, once a year we have a 10% pullback. We haven't had a 10% pullback for almost 3 years, and even then we had a 10% pullback. So 6, 7, 4, we're due for a pullback, and you know, a rate hike or a catalyst could happen. We don't know, and that's why we don't want to, you know, bet the farm on it. And eventually that 10% correction will give us some opportunity where we can do some rebalances. We can take some things from safe assets and put it into some other aggressive assets that have gotten hit harder. We can do that, and we don't want to try and time the market, but I would definitely be mentally prepared for a 10% correction at some point in time. You know, I would say in the near future. I'd be ready for it at least in the near future. If it doesn't happen, great. If it does happen, you'll be prepared mentally for you know, a 10% pullback in the S&P 500. So those are my comments there. What are the investment implications here? You know, commodities has just gotten hit so hard. I think there's been some capitulation in commodities, especially in the last week or so. It doesn't mean that they can't continue to go lower, but I think if you were to look at oil and look at what's going on, and even with a slower global economy, and even with the U.S. supply being a little bit higher in oil, $45 a barrel is very low levels. And just in 2007 or in 2008, you had some prominent firms. I remember a UBS call that said, you know, oil was at 147-ish, and they made a call for oil at 200, and they had all these great reasons for why oil was at 200. Well, you know, those great reasons just didn't, you know, go away. They're still there, and maybe it's not 200, but maybe it's 75 or 80, but 45 seems very, very unlikely to be where oil is going to settle over the next few years. Hard currencies, so this is a inverse dollar play. We believe the dollar has gone up too much. I mean, it's gone up 20% in the last year. The dollar usually doesn't move like that. So reversion to the mean, trade deficit. These other countries have trade surpluses. That's why hard currencies look positive for us. Market neutral is just a way that we can get safer assets without being so much interest rate sensitive. So some of our bond portfolio in market neutral, and then emerging market equities, I already went through that they're undervalued. Underweights, fixed income, long duration. You know, we do believe interest rates are going to be ticking up here. We've thought that for a while now. You know, at some point it's going to happen, and we're positioned for it. Domestic equities have just done very well. It's not that we don't like domestic equities. We like equities more than fixed income. We prefer maybe emerging markets or even developed international to domestic, so we're slightly underweight our normal position in domestic equities. REITs and utilities, once again, increased interest rate environment. You're going to get people who are in these because they're reaching for yield, and you're going to get them to exit, and those two areas might have a tough go at it if we start to see interest rates increase. So with that, I'm going to skip this last slide here. I'm going to go ahead and go to questions since it's a little bit past 6 o'clock, and I know folks have to be elsewhere, so I want to make sure we get to questions.
As Sean said, feel free to gather any comments or questions you may have and type them into the chat box attached to your GoToWebinar panel. It may appear as a chat box or a question box, depending on the version of the GoToWebinar you're using.
I must have done a great job. There's no question. or everybody's just in the twilight zone now after I went through that long presentation. Anyway, if you guys do have questions that you think about, please feel free to shoot me an email. You know, we're available for you guys if you decide you did have a question and you just didn't get to it during the webinar. I'm more than happy to answer any questions anyone has offline via email. So don't feel shy. Send me questions if you have them. With that, I thank you guys for staying on. It looks like we had a ton of people on tonight, so I'm happy about that. We will see you guys all next quarter. We've got a couple events coming up. We'll get correspondence out on those. But until next time, thank you very much, and have a great night. Take care.